Welcome back to the What You Want More podcast. Today, I'm joined by one of my standing co-hosts, Mr. Alex Stewart. Welcome back from vacation. Great to have you here today.
Oh, glad to be here. This is a big one.
Yeah, man, we're excited. We got a lot to talk about. And matter of fact, we got so much to talk about. We've been invited to quite a few podcasts that we're going to be on here recently. We'll be plugging those and letting you know. But we were recently just on one for the Chrisman commentary with Robbie Chrisman from Mortgage Daily News. That's episode 315-23. If you get a chance, check that out on Apple Podcasts and Spotify. They got all of our opinions on what's going on in the market, what are rates going to do, CPI, this, all the stuff we talk about. But it was great being on that show. So if you get a chance, check that out at the Chrisman commentary on Apple Podcasts and on Spotify. So let's get what we're going to talk about today. And we just had two epic banks collapse. We did a whole episode on that on episode 40. Here we are coming in on part 2 of that today. We've had CPI readings come in, and we've got the looming Federal Reserve. And today we're going to talk about all that. We're also going to talk about how it applies to everybody that's listening to this, the impacts, the fallouts, the ripple effect, but also going to talk about what's kind of looming in the future there and what we see coming, because, you know, we don't even have a difference of opinion. We kind of feel like we see exactly what's coming down the pipe here. So let's just go ahead and let's just kind of, for those that didn't get a chance to listen to episode 40, here we are. SVB, Silicon Valley Bank, collapsed. We did a whole thing on that. Signature Banks collapsed. We've got some other banks here in the U.S. that are in trouble. First Republic, as we talk, is fighting stock price basically being deteriorated. They've had an infusion of money from other banks saying, hey, listen, we got you. We're going to help you out. But there's still fear in the market of what's going on. And then we've got Credit Suisse over the seas that's had their issues as well. And this is all a domino effect of what we're getting ready to talk about. And the reality is, we've had the Federal Reserve raising rates. And Alex, you weren't here for the last victory lap, so I'll let you have this one. We talked about, on episode 8, we talked about, hey, listen, the Federal Reserve cannot continue to raise rates at the rate they're doing without there being some sort of impact. Yeah. And that impact, we said, they're going to go until they break something. Right. And we specifically said the European Central Bank, we said the stock market, or we said the banking system here in America. Yep. One of those three things was going to break. We've got particularly cracks in all three of those right now that are happening right in front of us. Yeah. And so, you know, as we talk about this, is this the tip? Are we at the tipping point of a financial crisis right now, Alex?
Yeah, I mean, this is a surreal time. I remember when it was 2020, 2021, we'd look at the market and we'd be like, this is going to be like record book history-making moments, and we're living right through it. Right. We're never going to see this kind of a situation again, most likely. And you don't really appreciate it while it's happening if you don't have that context. And we're in another one of those moments where I look at this and I'm thinking, you know, a lot of us would go back to 08 or 06 or 07, whatever the time frame would be, and you don't necessarily pin a specific day that you think about. This is one that may be in all of our memories for a long time of, hey, I remember when SVP when they went down, that was the first domino of many. And, you know, I think you and I both agree this is probably more of the tip of the iceberg than it is an isolated event. And, you know, I sort of think about it like a forest fire, right? If there is a fire burning in one part of the state, in one part of the country, that can easily spread to consume everything if it's not somehow put out. And the biggest thing that I think is worth noting that we haven't talked a whole lot about is the speed to response that we're seeing so far, right? Like back in 08, Fed caused a lot of issues, things crashed, and then it took a while. They let it fall down, and then they started to pick the pieces back up.
Yeah, let's back up a little bit here, because one of the things I think that we're missing in all of this is, you know, let's say there's a generation right now that's actually finally understanding what a financial warfare looks like, right? And that is the millennial generation. They have not seen the fallout, if you may, of any type of financial turmoil while working, right? They've seen it as a child, but they haven't seen it in the workforce, and they haven't seen it in the housing, and they haven't seen it in the financials, and they haven't seen any of these repercussions of basically some monetary policy.
Right.
And now we're starting to see that. So to your point, in 07 and 08, the Federal Reserve maybe didn't step in, and the U.S. Treasury didn't step in soon enough, which the domino effect was so rapid. But that domino effect was vastly different than what we're seeing right now. That domino effect was more of a stock market domino effect and collapse of shareholders' 401k accounts. You can't run to the stock market and physically put your hands on a stock certificate or money. What happened in this case is a fear pandemic
Yeah.
caused people to go, wait a minute, is my cash the thing I need to survive and pay my bills? Is that okay?
Sure.
And I think it also speaks to what happened right here is how fragile people's thought processes can be. Because that bank run that happened was completely unnecessary. Completely unnecessary. We just spoke about that in the last episode. That didn't need to happen. That was a Twitter-infused bank run with some people causing some pandemic and pandemonium to their own benefit as they shorted the stock.
Yep.
But in this case, to your point, the Federal Reserve rushed to help in a much quicker stance than 07 and 08. So go ahead.
Right. Yeah. And I think we also have a recency bias where we remember '08. And that's what we think is going to exactly happen this time because it's the most recent thing and it's the thing that's most similar to what we feel like. If you go back in time, though, every one of these things is different, right?
Sure.
'01 was very different than '08. It was very different than '91, which was very different than '29, right? Every one of these is a different flavor, has different. So if I know one thing, it's probably that this is going to be different than '08. I think you and I are we're biased towards housing, but I don't think that we view this as a housing crisis like '08. But it absolutely could be a credit event like '08 where you have a significant shock to the financial system. We didn't have an inflation problem in '08. We have an inflation problem right now, and that's going to totally change how this is approached, right? Because I think what we've been waiting for and what the market's been waiting for is a Fed pivot.
Yeah.
I think we've got it. I think it's the start of it. And what's interesting, and we'll talk about this, is the Fed meets and is going to have a rate decision next week. I think the market's saying it's either going to be confirmed or denied.
Right.
They've pivoted, and either way, we think at the end of the day, it's probably going to go a certain direction.
Yeah, for the record, every time I hear you say pivot right now, I think of that episode of Friends where Ross is carrying the couch up with Jennifer Aniston and with Chandler, and he's like, pivot! And they turn, pivot! And that's where I think you are right now with the Federal Reserve, is that we're at pivot, right?
Right.
Because we both think that they don't have the bravado next week to essentially say, we're going to raise it. Now, we saw the European Central Bank come out of nowhere and raise, but I don't think the Federal Reserve has the bravado to do it because I think the banking system has its flaws. But I don't think there's a need for pandemonium and panic that we just saw. However, raise it a quarter, that probably could add more fuel to that fire. I think if we were a month removed from this happening, we could see that quarter raise, maybe a little bit more. But I think being just within a week, nothing. I'm like you. They're going to pivot. Ross is yelling pivot in the background right now, and the Federal Reserve's got to figure it out. So I agree with you 100% there.
Yeah, and I guess in layman terms, just to sort of also say this, when we say that they're going to pivot, think about it like this. They're going to go from trying to put out a fire to putting gasoline on the fire to try to get the fire to come back, right?
Yeah.
They have been pouring water on a fire for the last 6 months, 9 months to try to get inflation to slow down, to try to slow the economy down because inflation was an issue. Now all of a sudden they're going, we might have put this out permanently. If we crash this, we need to pour a bunch of stimulant on this thing to get it back to going. We're going to EKG that heart rate on those banks. So it's going to be interesting to watch.
Let's just talk a little bit about what's happened here. So in the week of SVB right now, you've probably read throughout all the papers or internet blogs or news channels. It's, I feel like,
the social medias.
Yeah, definitely. Tracy Chapman, give them something to talk about. It's playing in the background. But that's what they've done for the media right now, is that we've given them something to talk about. And so they're going to wear this out and new things will unfold. But in the meantime, we keep talking about inflation because what we want our audience to understand is that's the silent tax. Yeah. That's the silent tax because, we heard the president come out and go, the taxpayers will bear no bearing of this. This will not burden them.
Yep.
You're probably correct in the form, I'm not going to raise your taxes, but the silent tax, that's going to be the implication is because leave no doubt here, we just reinflated the system by every dollar we just put in there.
Right.
All 200 trillion, boom, raising the inflation. Because we're putting more money back into the monetary system. We got the print presses back open and going here. So that's the silent tax. You're going to bear that burden. You're going to bear that burden at all different assets of your checking account, your savings account. That money's no longer going to be worth what it is when it's in there because we keep inflating the dollar.
Yeah, for instance, just to specify, they lost money and the government's giving money to replace the money they lost, and they're acting as if it came from this fund. And so the money was always over here, so it's not new money. But the reality is they've said, we're going to make the banks pay for this. And
Yeah.
you and I both have talked many a time of, okay, well, you make the banks pay for this. Guess what? That's going to get passed down to the consumer. They're going to pay for that ultimately.
Yeah. And so, let's talk about, I think there was a Congressman, Republican Jeff Jackson out of North Carolina, who took to Twitter and TikTok and, is getting just, all the rave reviews for this 2-minute video he did, where he actually breaks down all this topic manner of why they did what they did, the special meeting that happened at 2 a.m. in the morning, what they did, how they called it, all this wonderful stuff. And, I think the idea behind that was to calm the American people down and say, don't go run the banks. That was the ending of the message. Sure. But the beginning and the ending of that was, to your point that we talked about earlier for the show, is that they didn't catch this. That's one of the things he keeps saying in that video. We caught this early enough. No, you didn't. You didn't catch it early enough because we got 2 banks that have collapsed. And, now we're going to have to go ahead and replace those deposits. And in the video, one of the things the president said, and this video said, is that you, the taxpayers, will not pay a dime in this. This will come from a fund. And they were real coy how they said that. It comes from a fund that the banks pay the federal government.
Yep.
What's that fund called?
FDIC, right?
It's called the FDIC fund. Yep. Let's call it what it is. And so essentially, just for real quick explanation, when a bank takes a deposit, that's a liability. We've talked about that, right? And the bank has to go take 90% of that and go find a way to hedge that liability to make money in order to pay you money. But they also have to account for about 1%. It's usually a little less than that, but for the tense of this conversation, they take 1% of the total deposits and they put it in the FDIC fund.
It's like a rainy day savings account, right?
It's exactly, you're paying
emergency
for
fund.
It's an emergency fund, right? Yep. You're throwing into the emergency fund the default fund. That's really what it is, right? It's a default fund. Now, what's interesting about that is that they're going to increase that amount for the banks, right? They're going to increase it. Are they going to do a one-time increase? Are they going to do a forever increase from 1% to 2%? What are they going to do? Now, what you're doing is you're putting more cost into the bank now.
Right.
So to your point, the bank is going to not absorb that cost.
Yep.
They're going to pass that cost down, and they're going to pass it down in some other way. They're going to raise maybe an ATM fee. Yep. Maybe free checking is no longer free checking. I mean, there are all kinds of ways you're going to see that passed into the financial system. The banks are not going to absorb that. Yep. So in a way, the taxpayers are going to absorb that burden. It just won't be in the form of the administration raising your taxes, correct?
Yeah, well, and interest rates will be higher on mortgages. Potentially, the savings accounts will yield less, right? We've seen this now where the government has a rate of 5%, but your checking account's only giving you 3%. Well, where's that extra 2 going, right?
Right, and when you say government, you mean the treasury spreads,
correct?
Right? Yeah.
Correct. And I think the other thing that people don't recognize, and we've talked about this locally, this is a consolidation phase. This is happening. This is a natural phase where we have gone from chaos, where there's a bunch of players in the market, profits get squeezed, people go out of business. Now it's a consolidation phase where certain banks are going to get bought up, they're going to go out of business, and we're going to end up with fewer banks. And this is a long-term trend. You look back the last 100 years, we had way more banks that were in operation over the history of this that we've slowly consolidated, and everybody remembers, right? You were banking with this, and now there's a Truist, or there was Wachovia, and now it's SunTrust or whatever, right?
So let's put in perspective here. Every industry goes through this cycle, and it'll take 2 seconds to explain it, but the cycle starts at a level of calmness,
right?
And then it goes to innovation, and then from innovation to chaos, and from chaos to basically to consolidation, back to calmness.
Right.
There's a cycle that happens there. Every industry goes through it, and right now we're in that consolidation phase before we get back to calmness, right? And there's no time frame on how long this phase could last, or even the whole cycle. I mean, we've seen cycles happen in 6 months. We've seen it take 6 years.
Right.
But I mean, you and I at the market facility, we talk about this all the time.
Right.
But I mean, you could use the airlines, for example, just for our audience to briefly understand. There was a time in the 70s and 80s where you would go to the airlines to book your airline tickets, right? And then this innovation phase came about, and you had travel agencies, right? And then even further in the 90s, that innovation was your Gnomes, your Kayaks, your Expedias, your Travelocity, right?
Orbits.
And then the chaos happened because all these orbits, everything came out, hotels.com, everything came out of there, right? And then the consolidation phase happened, and now all those things are owned by really 2 entities. And there really aren't travel agents anymore. I mean, there might be a few that exist, but there's really not a lot. It's all been consolidated. But now in the calm phase, most people go back to the airline's website just to buy the ticket direct.
Yeah.
You're back to where you started, right?
Hey, travel advisors may be making a resurgent. You never know,
You
right?
never know, right? So, I mean, but that's just an example of how those cycles
Sure.
work. So to your point, in our banking cycle, you're seeing the big dogs do the consolidation right now.
Well, and that I know I probably am on a more of a conspiracy side than you are.
I know you are.
And here's what I have read about, and here's what I think logically is not an unreasonable thing to think.
Sure.
The JP Morgans of the world encouraging the bigger companies that had accounts at SVP to say, I don't know if you guys have looked lately, but your deposits may not be as safe. You should really consider moving to a bank that's got a much bigger balance sheet, that's got a longer standing history, that's more stable. And just a little whisper in the air can be that spark that starts that fire. And at the end of the day, the hard part for the consumer is we're left with fewer choices, which means what? Higher costs. Which means less options. You're not going to be able to have more competition in the market. And ultimately, the banks are going to pay for it. Well, if there's only 5 banks left at the end of this, guess what? Not very hard to say, okay, well, we're all going to go to this sort of a model.
Right.
And these are going to be the costs, and there's not as much competition, so we can do that.
Yeah, and let me back up and kind of make a point here that you're talking about. You know, the JP Morgans of the world, they might as well be the poster child for too big to fail.
Sure.
Right. But I think what the FDIC, the U.S. Treasury, and the federal government and the Federal Reserve just told the general public and every bank, you're all too big to fail.
Sure.
Because what they could have done is they could have let that fail. Now, would that have hurt some innocent depositors? Yeah. But when I look at the financials of SVB, only 12% of their deposits were under $250,000. When I look at Signature Bank, only 10% of their total deposits were under $250,000. What I would rather have seen the FDIC do is come in and say, we'll make those depositors hold right away. But then we're going to evaluate some other things going on over here. Because if it's a company, right? If it was one of those major companies, Venmo, Shopify, Etsy, okay, yeah, they've got to pay people and they've got payrolls that are outstanding. Let's get the payrolls hold. But maybe those individuals, and you know they're out there, that had millions of dollars in an account, that's their own fault. Like you knew the rules of engagement. It was $250,000. Why you had more of that in there leads to question, what were you getting? Like what kind of rate of return were you getting? What kind of special treatment could you have been getting? And why in the heck was that there?
Well, and you get lulled to sleep thinking it's safe, right? But it's an assumed risk. You can't
exactly.
Everybody knew that this was the rules of the game.
Yeah.
They just don't expect a bank to fail.
So a couple of things that are going to happen in 2008, the FDIC insurance model was $100,000 per account.
Right.
They raised it in 2009 to $250,000. Probably going to raise it again after this. That's probably what you're going to see happen. They're going to raise it again, and by raising it, they can apply that fee to the fund to say, listen, we need more funds in here because we're raising that amount. That makes sense. I could see that happening as well.
Sure.
So what we've done, though, effectively is kick the can down the road for inflation, right? And we also just discussed what we think the Federal Reserve is going to do. They're going to pivot, kicking the can down the road furthermore, and that we're going to see further inflationary problems in the next 6 months unveil. But now, let's talk about the now. Right now, what we're seeing is that we're seeing lagging information come in on the index. So right now, it looks like we're not really winning the inflation battle right now. We're not really losing it. We're just kind of stagnant a little bit. But we think it's going to come down a little bit, as we've been saying, because these numbers that are lagging are going to come through in the month of May. And it's going to drop, and it's going to give us this false sense of security, especially on the heels of what just happened, that, hey, we're actually improving things. But just like all roller coasters, when they come down, they go roaring right back up. And I think that's exactly what's about to happen in the fourth quarter, and we'll see it, especially if they pivot here.
Well, and a good way to illustrate this or think about this for the public is a diet and health, right? We can talk about weight gain. If you eat a bunch of trash, you're not going to be fat in an hour, right? Like you're not going to be fat in a day. You'll be fat over time if you continue to eat all that stuff. But if you go on a diet for a week, you're also not going to be skinny the next day, right? Like it takes time. And what I think happened is the Fed has been chowing down for a long time on this monetary stimulus, and then they go on a 6-week diet and think that they can lose all that weight, and then they go back to eating again and think, okay, well, we got to go back to eat because my stomach was really growling and I was really kind of moody, and all of a sudden I got a headache. Like that's not going to work well. And I think
and this food and this diet is quantitative easing, quantitative tightening.
It's printing money.
Yeah,
yep.
exactly.
And it's funny because we had this scheduled to talk about the CPI, given how significant it is. And that report came out, but it was overshadowed by everything that was going on in the week. And, everybody's heard of that story where there's two wolves on your shoulders and whichever one you feed wins, right? One's positive, one's negative. In here, I think the market's got two wolves, and one is, financial collapse, and the other is inflationary issues. And they're both battling it out right now, but we've sort of forgotten about this inflation one because all of a sudden the one about the financial collapse is barking a lot louder.
Sure.
But we got those numbers and they were not good. I mean, we're still at 6% inflation.
Yep.
And if you pivot and you start printing money and you're at 6, it's like, I lost 2 pounds, I weigh 400. Let me just go ahead and back to eat. I think I'm making some good progress. Like that's not enough.
Right. Well, and I think the example that we're talking about here is we had this whole podcast, as you said, scheduled in advance to the reading of the CPI to talk about and break it down and talk about the impacts to, the financial markets, real estate, and how we can help buyers. I think we're at a point right now where, if you're in the real estate game, you're about to see some victories in mortgage interest rates. You're probably already witnessing them right now as we're seeing massive deterioration of the 10-year rate. We're also seeing a little bit of what we call yield control curving happening. And what I mean by that is what got SVB in the vast of their trouble was investing their assets in long-term bonds, which would traditionally outrun short-term bonds. But because of what the Federal Reserve was doing at such a rampant rate, it actually put them in a short-term predicament. And so what we're seeing is the Fed essentially controlling the curve, trying to get those short-term interest rates down by doing what they're doing right now. And essentially that's another reason why they're going to have to pivot. They can't raise it. They can't infuse more situations in there. The Fed has come out with their bazooka buyback is what I call it, and telling banks that if you have some of these they're not toxic assets, but if you have some of these hold to maturity bonds that are upside down, we're going to buy them at the value in which you purchased them to get you out of this upside down situation you're in. And, and as we chart and look at the 10-year treasuries, because that's where most of these upside down bonds are, there's a cliff. It's fallen off because the Federal Reserve is buying. I mean, and we won't get the report till next week of what all they've purchased, but it's got to be trillions of dollars that they're buying right now, causing this downward pressure to the 10 years. So what I'm getting at for our buyers here, your rates are going to get better.
Yep.
We've been talking about that. You're probably already seeing some rates in the 5s. You're probably witnessing that, upper 5s at this point, depending on which lender you're working with. If you're a real estate agent, you've had that person that said, I can't do this at 6.5, much less 7. Now's the time. This person at 5, it's time to go. It is there.
Yep.
And I think it's going to be there for a little bit, and it's just going to be there for a short window. I'm not talking like a week or 2 weeks, but we could probably see this till the end of July, and it could be a huge win for our industry in the mortgage world, in the real estate world.
Well, and the reason why is because these reports are lagging, right? So it takes time. So this inflation, just like it didn't show up immediately in the beginning and wasn't an issue very quickly,
right?
We may see a lag, and there may be some short-term, hey, inflation's coming down, because it's going to take a while for this money to make its way through the system. I was smiling at you because I always love a good analogy. I think it makes it easy to understand a lot of complicated things. And what came to my head, you'll tell me if this is good or not. This is like SVB had invested in Beanie Babies. Right at the peak, they bought all the Beanie Babies everywhere, and then suddenly they weren't worth anything. And the Fed's coming, okay, I'm going to buy all these Beanie Babies for the price you paid for them, even though nobody wants them, and they're going to sit in my attic. To me, that is a way that I think about this stuff, and hopefully that helps the general public understand what is actually happening here, and why that's so ludicrous that they would pay, hundreds of dollars for your Princess Diana Beanie Baby when it's only worth $3.
And it reminds me of the tulip.
Sure,
bulb,
the tulip craze, yeah.
The tulip craze in the 1600s and 1700s, the tulip mania, as they called it.
Yeah.
And as we've seen, you've heard, the historians tell that story. What we found out is that, the craze wasn't necessarily the real deal. And just like the tulip, mania collapsed, a lot of people reference that around crypto. A lot of people reference that around gold. I mean, I've heard it over and over again. But the reality is we have a history as society and individuals to gravitate towards these crazes, if you may.
Sure.
And so therefore that bleeds into our business, and we do the same thing. And so I think one of the biggest mistakes that SVB, and again, this is not a political perspective, but they did buy into the hype that there's no recession.
Yeah.
And that this, if you look at when the bulk of their bonds were purchased in 21, we were being told by Janet Yellen, transitory. This is all transitory. This is temporary. And, and if you agreed with that thought process and your investment strategy agreed with that thought process, that's probably why they bought those long-term bonds, because they didn't think this would happen. And they also didn't think and give enough credit to the Federal Reserve stepping in and saying, we're going to raise, and we're going to raise, and we're going to raise it again.
Right.
So that's what kind of put them in a corner here. And I'll go back to, what Daniel and I talked about last episode. If there wasn't a run on the bank that was digitally created through social media, that bank would still be in business.
Sure.
And they would not have been shut down and bailed out, and the bailout wouldn't have happened.
Yeah.
So think about that for a second, that if people weren't knocking on the doorstep saying, I want my cash, I want my money, this wouldn't have happened.
Yeah, I do. I will say this as a counterpoint. I do think if it wasn't them, it was going to be somebody else. If you think about what a zero interest rate policy has done for 10 years, meaning, if you've got money and you want to invest it, and everything is only going to give you 1 or 2% on your money, you say, well, where can I actually put it to try to grow my money? There was a ton of investment in what's called private equity, meaning I'm going to invest in a private company rather than a public stock or something like that. We haven't even heard anything about that yet, right? And we know that a lot of the projections of what those investments were going to do were based on rates staying really low.
Correct.
So that you could really borrow a lot of money. It didn't cost you a lot. You could grow a company really fast, and it was going to be worth a lot. I think we've got a lot of the iceberg under the water still with stuff like that, where treasuries, that's actually, like you just said, that's not a toxic asset.
It's not.
Just it was a bad timing. But the toxic asset absolutely could be, I invested in all these startups. They have absolutely no profit. It only made sense because that was the only place I could put money to actually try to get a return.
Yep.
And now those startups are going to go out of business, right?
Yeah. Well, when we take a look at, here's a number, and not to freak the audience out, but, there's over $1 trillion with a T of deposits that are
We're so desensitized to that, by the way.
Like, that doesn't even $1 trillion. But the reality is there's $1 trillion that are not insured, meaning the accounts are over $250,000 in the United States. And the fund that we refer to is only about $180 billion with the FDIC. So simple math tells us there's a shortage there, right?
Yep.
And I would challenge there's probably more than $1 trillion. That's just the quick reporting that we've gotten. I think there's more than that in the financial system, because there's $22 trillion in deposits, right? Yep. So you can't believe that, you can't think only 5% of them are over. I think there's more than that. And then there's some banks out there that are heavily leveraged and over that as well. And so that's why I think the Federal Reserve and the FDIC and the United States Treasury Department set a precedent when they bailed out Signature, and they bailed out. That's what it was. It's a bailout. You can call it a quasi bailout. You can call it, making depositors whole. It's a bailout any way you look at it, because they stepped in and fixed the situation. That's the definition of bailing it out. But when you look at those banks, there's a lot out there that have those uninsured, and so they just set the precedent that we're going to do that for everybody.
Sure.
And that open up the print presses, whatever it takes. And so the implications of that are this: you're devaluing the dollar when you do that at a rapid rate. I mean, a rapid rate.
Right.
And the international implications of that, it wasn't too long ago, you and I were sitting on the mic here talking about how strong the U.S. dollar was, and how, essentially that if you were going to take a trip overseas against the euro, you had buying power. That isn't going to stand for long. And if you look at what we're doing right now, we are devaluing that. Gold is going up.
Right.
Your commodities, your hard assets are going up. Real estate. And what you find is this, that when people stop losing, or when, faith in the USD, which is what is happening right now, all of a sudden, other things start to reap the benefit: gold, silver, housing, commodities, things you can put your hands on. And that is that's a big deal for us, because that's going to affect us in our trades. Yep. That's going to affect us in our GDP. That's going to affect us in a lot of things that are going to fuel this tip of the iceberg recession, because here's what happened. You have negative GDPs. That's the start, right? That's the definition of it. But you usually are out of a recession or well into one before you realize you're into one, because the actual economics of it haven't shown up yet. Right. But this is going to show up in a lot of things for us. We're already seeing oil start to come way down. Yep. I mean, there's a lot of things on this radar here that are flashing. Hey, man, we're at a tipping point right now, and that tipping point is it's going to be big if it tips the wrong way.
Right. Yeah, and it's very hard to know what to make of a lot of this for the general public. But I think as we look forward to what's going to happen next week, I think we're going to get either confirmation or a statement of trying to not confirm that the Fed's pivoted. I've seen a lot of people reference how if you just look at the 2-year Treasury, you'll know what the Fed's going to do.
Sure.
And that has gone from being indicating that they were actually going to continue hiking because interest or inflation was high to now it looks like they'll probably stay put where they are. If I was a betting man, I would say
nothing. We're going to
they're going to just keep it and say we're just going to sit tight and we're going to evaluate before we make a move either way. Because if they cut. And anyway, you look back in history, they go up quick and they come down quick. There's not a lot of time sitting flat at the top, right?
Yeah.
So I think we're on the precipice of seeing the Fed cut rates. I think we're on the precipice of seeing a lot of stimulus happen. And the choice politically is a lot easier to say, I'll deal with inflation over here rather than a crisis over there.
Yeah, no doubt. And I also think that we're in the midst of getting to a midterm and getting into the election year, and we're starting to see, the impacts of that affect financial decisions and the monetary policy as well. All of that is going to be very tough to navigate. And to your point, you would rather deal with inflation, pass that buck down, than deal with some of than hit it head on, right? Because hitting it head on is going to be painful. Sure. It's not going to be fun, and
it's not politically acceptable.
Yeah, and we were in the midst of addressing it. We were probably in the midst of doing that all the way through 23. I think what we're prepared to wrap our head around, the two of us, is that we're probably in a decade of potential inflationary measures right now. Sure. I mean, if you think about it, we had a decade of very low inflation. And if you also go back to those low levels, the Federal Reserve really could do whatever they wanted at that point. Raise rates, lower rates. It didn't matter. Inflation, they couldn't move the needle. Now, here it is. It's not only been moved, it's off the radar. And it's like, oh, well, wow, how do we get it back? And in the midst of all of that, we also allowed some other organizations that are really important to the financial system get leveraged in the wrong direction, and we're making it worse by doing what we're doing. So, it'll be interesting to see what they do on Tuesday and Wednesday. I think everyone will be glued to that announcement at 2 o'clock when it comes out on Wednesday. But I think what they're going to find is exactly what you're saying. It's going to hit the pause button. Worst case scenario, maybe we get a quarter discount and ease a little bit. Maybe.
That's maybe. Talk about the dam breaking. If they do that, everybody and their mom is going to front run them continuing to get down because they know it's going to go to zero faster than everybody thinks. But let's talk about what people can do going forward. Okay. I mean, I think that's really important. We can talk about all this and we can say 10 years of inflation. But it's really important that we start to think about, okay, what opportunities does this present to us, right?
Yes, and there are a lot of opportunities in the market.
Right. I mean, how many people have you heard say, I wish I could go back to 2008 and buy property?
All the time.
Now, keep in mind, things were very different. Property values went down a lot. But this may be the very beginning before property values started to go up dramatically, because we know that if there is a lot of inflation, you got to get out of dollars, out of cash just sitting in the bank, and you got to put that money somewhere where it's going to grow with inflation and keep up, right? So we've talked about I-bonds. We've talked about real estate. Do you have any other recommendations or thoughts of what people can actually do to hedge against this? Yeah,
for me right now, it's real estate.
Yep.
I think that's the best way you could do it. I mean, if you're not going to get a rate of return to hedge. A hedge to me is counterbalancing the current situation.
Right.
You might be able to reduce it with like a money market fund or something of that nature, but you're not going to hedge it.
Yeah.
The 90-day T-bill, I'll continue to stand behind, is a powerhouse right now. Because every 90 days it matures. So we talk about that hold to maturity. The hold to maturity is 91 days. It replenishes itself. You get the coupon rate. You go again if you want to do it. And those numbers are pretty darn good right now. It's actually leading the pack. I don't have it in front of me here.
4.5.
It's at 4.5. So APY 4.5. So what is that? It's like 1.125 every 90 days.
Right.
That's pretty darn good, right? There's some checking accounts that aren't even paying that permanently. So, but for me, the champ in this situation is real estate.
Right.
And it's hard for me to go back and look. We got a chart here that was given to us by our friends over at MBS Highway, but you take a look at this. Since 1942, there's only been, and I'm going to count it here, 7 years that real estate was negative. Right. 7. And of the 7, 3 of them were below 5%.
Yeah.
And the 5-year run where it was like, not good, -5, -12, -4, 4. That was during the crisis caused by real estate. So I guess what I'm saying is, if I go in here and I look at the highest levels of inflation, and Alex, you've always done a good job of illustrating this, every time we have an inflationary cycle, real estate's the winner.
Sure.
And if we go back to that really bad inflationary time that everybody compares what we're in right now, which would be the late 70s, early 80s, real estate went up 16% in 78, 14% in 79, 7% in 80, 5% in 81. Like, I look at that and I'm like, the champ is this right here. It's hard to bet against real estate. So the opportunity, I think, is going to be real estate. I think real estate will be the beneficiary of what we've been talking about. Rates dip, prices go up.
Yep.
That means values go up. Rates dip, more people run to the market and create demand. And that demand is going to create this run-up of real estate prices because we still have an inventory problem. We haven't solved that.
This is a necessity, right? This
Correct.
is not people buying their fifth home because they just want to have a home and they can get a loan because they have a pulse. This is people trying to find a place to live.
Yeah, they're not buying tools.
And renting is not cheap either, right?
So,
and I think it's also really important that we highlight that this housing, I think we get in the mindset of stocks, right? And I think especially millennials, and after going through COVID, everybody got into stock investing. And that's a volatile market. Sure. That is one where you can see, and we've seen it in these banks this past week, you can see a 60% change in value in one day. In real estate, you don't see that.
No.
Right? That's you cannot equate those two things. They are not alike in that regards. The best years, maybe 20%. The worst years we've seen, maybe down 10, 15%, unless you're in some highly speculative condo in Miami or something like that.
And
right?
I mean, we're talking 1 year. That's 1 year since 1942 that it was double digit backwards anywhere. And you only had 7 years in whole where they lost. And 2 of those 7s were at 1%. So I'd call that flat.
Right.
You know? I just think that it's hard to argue that. So, obviously we're real estate people. Obviously we're real estate investors. Obviously, we work in the banking business. But the reality is this: we think as a consumer, I can't say it enough. I know we sound like a broker. Now is the time. Like you need to get into, real estate, whether it's investment, whether it's primary, you need to take advantage of that because you're going to have a window here where if you missed out, you're going to get back into the 5s. And if you combine some of these strategies that we've talked about in our lending updates, you might find yourself in the low 4s.
Right.
And if you get on the front end of this, you're still going to have cooperative sellers.
Right.
So there's a lot going on there. But I would say this, we have a lot to unpack from the very beginning of this. There's not a lot to worry about in the form of, in my opinion, the banking system. I did want to stress that. I mean, the SVB wasn't doing anything different than other banks. They just happen to have a run on the bank.
The counterpoint there is I would argue we have a lot to worry about if they're not doing anything different than other banks.
Well, no, because I mean they're doing exactly reporting wise what they were engaged and allowed to do by the Frank-Dodd Act, right? And I think that also their investment strategy, while aggressive in the bond market, there's many a banks that are in the bond market. Yep. And I think there's many a banks that invest and use those deposits to traditionally lend out and get in front of, housing or small business loans, et cetera. But the reality is with all the PPP money, we don't really have a lot of SBA loans that are being lent out. And a lot of businesses don't need startup money right now because there's so much capitalization in the system. And then who wants to line up to get a rate when it's been in the 7s, now it's back down. But prior to right now, these were traditionally higher rates. Yeah. So they couldn't lend it out, so they had to go find something else to do with it. So I think the strategy of buying that many, 50% plus, I think it was like 53% of your assets you're using, I wouldn't have done that. Yeah. But there are banks that have bought those bonds as well, and we know it because the Federal Reserve just bought them all back. That's why I can say I don't think the banking system's I don't think the banking system is in trouble because the Federal Reserve has opened up the piggy bank and the print press, and they said, we will buy all of your assets that present any type of devalue. We'll buy them at full face value. So that's why I don't think there's a banking system as an issue anymore.
I am going to be interested to see if there is regional performance differences on real estate, such as these banks that are failing are in New York and California, right? We're not seeing rumors or hearing of things in maybe the southeastern region, which has shown a lot of strength in real estate compared to those other two. The California market is one where we know a lot of people are leaving. We know it's a high-cost state. We know that there is a lot of industry, the tech industry specifically, that's being affected by this economy. That's the market that I look at nationally and say, I don't know that we have the same rosy thought about real estate in California like we do in some of the other parts of the country, but that'll be something we'll be watching and keep track of.
And you brought up an interesting point. What do those two states typically also have in common with each other, Alex?
their color, their
Well, yeah, I mean, let's call it what it is. They are a very democratic state, right? And there's nothing wrong with that.
Yep.
But goes back to that original point. I said that no matter what's, and again, I'm not choosing sides here. That's a fact. So we're not choosing sides. That's a fact. And upon that fact, it was also the belief that the collapse of SVB and Signature Bank, because they bought into the belief systems of that there's nothing wrong with the economy. I'm going to continue to go back to that. It doesn't matter. I mean, listen, many of other administrations that were red have a lot of errors too. I'm not pointing out no one's perfect, both sides. But what we have is we've had a campaign in 21 that said there's nothing wrong with the economy. Even through 22, the economy is strong. We've heard that over and over again. Even in the opening remarks of the State of the Union, we are a country of resiliency and we are moving forward. We've heard all that. There's no recession looming. Inflation is transitory. And I'm not saying they didn't believe that. That's where I'm going with this. I'm not saying that they didn't believe it. I'm just saying that that's the belief is being delivered out there. And those two states that you're referring to have some banking issues, and you're starting to see those pop up. The Signature Bank's one of them. SVB, both in those states. And so when you talk about regionalized, where does that look at? Go to some states that don't necessarily, have that same representation, maybe don't believe that or disagree with it. More importantly, maybe their philosophy and how they banked and their philosophy and how they invested was different.
Yeah, absolutely. And they maybe have people that are going to be employed a lot longer and not need the money out of the bank, right?
Yeah, and let's hope that's the case for all the banks moving forward here. So I will stand behind. I don't think there's anything wrong with the banking system as we've had it. I do think that the appropriate measures were taken to stop anything like that. As we see that, the direct beneficiary is going to be the consumer on interest rates if you choose to go get a loan. Yep. But the indirect consequence is going to show up at your bank as those fund fees that the government refers to that are being funded will be passed back down. So it's just a matter of time, probably within the next 8 months to a year, till we start seeing that come through. Also, I think the stock market is on pins and needles till Tuesday and Wednesday, and we'll see if the pivot takes place. And we'll be watching as much as you guys, and we'll be back to talk about it. But to kind of switch gears a little bit. Before we go, I did want to say our next episode that drops is with John Gordon. So if you thought that this was a little doom and gloom and some negativity, the next episode will be all positivity, I can promise to you, because he is the positive person and the energy bus. And John Gordon, all the stuff he brings on the show there was amazing on the next one we dropped there. So if you want to listen to this one, followed up with that one, you'll be ready to go. But Alex, thanks again for being on the show today. If you guys like what you're hearing on here, please share our podcast, share any information that we have out there via Apple or Spotify, as well as our social channels. It's great having you on the show as always, Alex. I value and appreciate your time.
Yeah, pleasure to be here. I had a lot of fun doing this and looking forward to letting this unfold and being able to hopefully help guide our listeners through it.
Yeah, absolutely. Same here. Thanks again.
Yep.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.